Good morning. This is Kirk Spano, May 3rd, 2019. Good to see another 40, 50 of you on for the live portion, and for the several hundred to 1,000 or two that'll watch online later. Have a great weekend. I've been asked to put the codes and explain the services that I'm involved with. And right now, I own fundamentaltrends.com, and this is my flagship service. I just had the website rebuilt. Everything's pretty nice. Updating the content right now. Really has a lot going for it. And for those who would sign up here before I leave for Vegas, probably, maybe into summer, we'll see. But I'm taking about 200 new subscribers. We've actually had pretty good response. I'm taking 200 new subscribers instead of $9.99 a year, $4.99 a year. And the big difference between this and, say, margin of safety over at Seeking Alpha is that I have the swing trading service over at Fundamental Trends and a 401k service. So, for $4.99 a year, I'd probably go with Fundamental Trends over margin of safety. But if you love the margin of safety platform, you just don't want to change, you don't want to do the swing trading, that one's great too. So the Fundamental Trends Intelligent Investor Service is very similar to margin of safety investing minus the 401k advice. Although I am throwing the 401k advice up if I think it's hugely important. But the discount code is RARE50. You get 50% off, not just for the first year, but forever. So at some point, people are going to be paying $9.99 a year. I'll probably raise the rate to $19.99, and then I'll give it to them for half price at $9.99. But $4.99 a year. If you're not making money on that, then yell at me because you should be. FA Trader is where I post exclusively not exclusively, I'm working into it, but I'm the sustainable investing guy, analyst, really looking at solar, alternative energy, things like that. And I'm going to write about Tesla, and I'll even talk about them to start before we get in our core topic today. But FA Trader has 9 analysts. Looks like we're going to end up with 11 or 12. And we each put our two or three good ideas a week up on that website. It's like $30 a month, and right now there's a 30% discount, so you can get it for like $20 a month. Might be, I could be off by a few bucks, but if you go to my Twitter feed, I have a link, and my Facebook page. I also have a link that will take you directly to where you can get the 30% discount. And people who have tried that service, and you can look in the chat room, somebody already said something. FA Trader is a great service. I mean, you're getting, 9 to eventually 12 analysts for the price of one. So if you already subscribe to me, you're not going to get much new from me over there because you're already getting it on my other sites. But you're going to get, all these other analysts for, less than it costs to subscribe to Bloomberg. And, I think it's probably a pretty great service. I don't make anything on that website. I make like $500 a month. So, I put it up there because I think sustainable investing is important, and I like the people involved. If it grows to something, it grows to something. But I'm making my money managing money and on the bigger subscription services. So I just think that the FA Trader is a pretty good bargain. So let's move on to our core topic. Oops. Let me get there. There we go. Now it loves me. Actually, I'm going to not start with our core topic. Let's talk about Tesla for just a minute, and then we'll get into our core topic. As you guys can see, I subscribe to Zach's. I've got a lot of subscriptions. So, I'm sharing what I think are all the best ideas from all of these places. And then every now and then I come up with something myself. So I told you last week, and I said it in somebody else's interview. The Seeking Alpha, I have an interview coming up out on Tuesday or Wednesday about Kinder Morgan. But I was making a broader point, and I mentioned Tesla, and I said, the thing about Tesla is that the bears just got completely wrong is that anytime that Elon Musk needs money, he farts it. He does. He just, and that's the phrase I use. He just farts the money. And so today, Tesla raised $2.5 billion. How? They did a convertible note and they issued some stock. And so really, it's just all a stock offering because the convertibles will end up, going to stock. And now all of a sudden he's got $2.5 billion that buys him 2 or 3 years to become consistently profitable. And I'm going to put out a thesis in the next week or two, and I'm going to tell you what, I'm pretty certain that Cathie Wood is right about her general thesis. Now, she said this week that Tesla would go up to $4,000 a share. I'm not so sure that's right, but Tesla is going to get to $1,000 a share. And if you're short, you should take your profits right now because this guy is so smart and he's so far ahead of the market. And the thing that he's going to do next with the taxi service, with the Uber competitor, it's not going to be exactly how he described it because we're several years away from autonomous driving. He says the end of next year. It's not going to be the end of next year. The soonest we're going to really have autonomous driving is 2 to 3 years, but it's probably 4 to 6 years off. We have to have the 5G networks first. So, autonomous driving is probably 4 to 6 years from now between technology in the cars and the 5G networks. But who's to say that Elon Musk, all right, so this is going to be in the story. Who's to say that Elon Musk, and remember, I do my homework. I have channel checks. I've said some things to you over the last couple of years, and people are like, how the hell do you know that? That sounds speculative. And then a little while later, it happens. I don't make this stuff up. I talk to a lot of people, and I keep my mouth shut about who I'm talking to because otherwise they won't talk to me no more. So here's what I think is going to happen at Tesla. By next year, he's going to have a program, right? He came out with insurance, right? They're going to do their own insurance. And I don't know the details on that, but it makes sense to me that Liberty Mutual or somebody else, or probably Liberty Mutual plus a reinsurance company, are going to basically offer in-house insurance. Brilliant, right? Super smart, because the insurance companies were gouging him. And the reason the insurance companies were gouging him, it wasn't because insuring the Tesla is more expensive, right? Because the insurance company's argument was, hey, these cars cost twice as much. We have to charge you a whole lot of money to insure them. Well, but they're 93% less likely to be involved in an accident. Do you know that? A Tesla with the driver assist feature running is 93% less likely to have an accident than somebody who doesn't have that feature. Think about that. So let's suppose that next year, Elon Musk decides to go talk to Wells Fargo. So, somebody who needs a new line of business. And Wells Fargo sounds like a good candidate. Plus, they're big in car loans. What if he goes, hey, Wells Fargo, let's do a private label loan program where people who buy a Tesla and agree to be, let's call them Tesla Zip. Let be a Zip driver, whatever they call their service, until we have autonomous cars. We'll allow them to apply what they earn driving people around directly to their car payments. Think about that. So Tesla just handled all of their financing problems this morning. I was really hoping they get down to $200 a share. They're not gonna. There was big support at like 237, and they hit it and they bounced off, and now they did the financing and they're up $12. So I've been buying shares today. So I bought Tesla back, and I'll write about that. So if you're on live here, I tell you what, get your starter position. If it drops $20 a share, buy more. If it rises $20 a share and they have any other type of good news, maybe add the position. But I took a starter position today, and we'll see if it goes up or down $20, $30 first. But I think Tesla's going to 1,000. All the criticisms are wrong. The idea about he misses timelines, so what? Really, it's a so what thing. So what that he misses timelines? Intel did too, Apple did too, Microsoft did too. Big deal. It's technology. It's not really a car. It's a computer on wheels. So if you don't own Tesla, at least a starter position, I understand it if you're super risk averse and you just don't understand it, and you don't understand it, that's fine. Don't invest. But they're going to grow to a double-digit percentage of market share. I don't know if it'll be 10% or 20%, but it'll be somewhere in there. And the people who talk about the competition, you just got it wrong. People who like BMWs will go out and buy a BMW. People who like Jaguars, I don't know how many of them are left, may go out and buy a Jaguar. People who like VWs may go buy a VW. But the reality is that Tesla is eating way into GM's and Ford's market share and Chrysler's. And, those are big companies. That's 40% of the market between the three of them. And then you got Toyota. So those four companies are over half of the market share. So when you talk about all these little companies that compete with Tesla, it's just not the case. Tesla's brand among people who want an EV it's the only one. It's the only one. And I've driven the BMW. It's a nice car, but I wouldn't buy a BMW before I buy a Tesla. I mean, Elon Musk is changing the world. There is value in the fact that 70% or so of the population thinks that what he's doing is important, and those are real polls. Those are real numbers. So he's got an edge with 2/3 of the population, give or take. That's gonna be a big deal as people go from gasoline to EVs, and we know the gasoline's not going to get super cheap again for a while. It will eventually. Eventually, there's going to be too many pipes in the ground. I think that eventually, countries who need the money or cheap energy, are going to drill for their oil. So you're going to see 10 or 20 countries that have resources just say, we might not be able to sell it to anybody, but we can use it cheap. And if they can get their own oil for $10 or $20 less a barrel than what Saudi Arabia and the United States are going to sell it to them for, they're going to do it. So at some point in the 2020s, there's too much oil being produced again, and prices crash down to $30, $40 a barrel, probably 40, maybe 30, I don't know, we'll see. But between now and then, the next 5, 6, 7, 8 years, people are going to start saying, I don't know about this oil. I'm going to buy that EV now that the EV is about the same price as an internal combustion engine car, and that's right around the corner. That also is only 4 to 6 years away, and it might be less. Toyota already has the hybrids that are only about $1,000 to $2,000 more than their internal combustion engine cars. I don't know why Toyota would even sell a regular gasoline car. They have hybrids for $2,000 more or $1,000 more. Why wouldn't they just sell hybrids exclusively and dominate that market for a while? So in any case, quick thoughts on Tesla. That's what that was. When I do quick thoughts pieces at margin of safety investing and fundamental trends, I just say Tesla quick thoughts, and then I rant like that for 400 words and get rolling. So I like Tesla here in this spot. I think they solved their financing problem. They just bought themselves years, and in those years, they're going to launch other things, and they're going to have technology improvement, and they're just going to keep growing. And as the price of a Tesla comes down, and it will, more and more people are going to buy them. And that's just the way it is. As soon as the Model X gets to about $75,000, I'll probably buy one. I will. By then they'll have a better battery, better technology, maybe even, the level 4 driving. So there's 5 levels of autonomous driving. Level 5 is like, hey, it drives itself. Level 4 is it almost drives itself, but you should probably stay awake. They'll have level 4 probably within the next 2 years. Basically, we don't let you to fall asleep while you're driving, but it'll do almost everything for you. Just stay awake just in case there's, like a deer, that it doesn't understand. So, I think at about 75,000, I've done the math. for the 30,000 miles a year I drive, about 75,000, it's cheaper for me to buy a Tesla Model X than it is to buy a $50,000 SUV, right? And so then I look at my kids and I say, okay, what should my kids do? Because, you know, they're not buying $50,000 anything. And, you know, I say, okay, well, they can get a Camry right now for $32,000, a hybrid. What happens if the Model 3 really is selling for between $30,000 and $35,000 loaded in the next 2 years? I think it's gonna, you know, they're gonna be real close to that. Yeah, $30,000 to $35,000, that Model 3 is gonna crush. So, you know, keep an eye on that. I think that if you don't have a starter position now that they've done the financing, and I think we all hoped, right? We were all greedy. We were all hoping they get down to 200. I think you're making a mistake. I think you got a four-bagger on your hand here if you buy it right around 250. I think for sure it's going to 1,000. I don't know how long it'll take. It might take 4 to 6 years, but if you quadruple your money in 4 to 6 years, are you going to complain? Probably not, right? All right, so let's talk about the main topic today. Understanding and investing in a slow growth forever global economy. People who know me know we've talked about this a lot, but I keep getting questions about this. What does this mean? Why do certain things happen? And I get the same Austrian economist slanted arguments all the time. And so when I talk about why we're going to need helicopter money to bail out the retirement system sometime in the next decade or so, they're like, well, why do we have to do that? And why does the government just limit their spending? And I get that one all the time. So the United States spends about 20% of our GDP on, I'm actually going to pull that chart up for you. Might actually have it. Well, the United States spends about 20% of GDP on government programs. And if I can find the chart, I know where to find it. You know where I posted it? I posted it at FA Trader. There you go. There's a reason to belong to FA Trader. Yeah, the amount of government spending just hasn't accelerated that much, right? So during recessions, we spend more, and during World War II, we spent a bunch. We've never spent like that before. I'm trying to find a chart for you. I really want you to... whatever. I'll find it. In any case, demographics are really the big deal. It's not that the government spends too much money. Now, if we started to do some of the things that AOC, Alexandria Ocasio-Cortez, suggests, we'd be in big trouble. There is no reason to believe that a country can just spend as much as they want. There are certain limits, and I think that it's important for us to understand that there are limits, because if we don't, then, you know, eventually we get into a big problem, and it requires all sorts of monkey business when it comes to monetary and fiscal policy. But the real thing that people don't understand is that it's not just about government spending. Government spending, again, has been choppy, but in the same range for 40 years, since Reagan. And during that period, we've gotten extremely wealthy. We have a huge wealth inequality problem because the regulatory and tax frameworks are not level playing fields. So my argument, and some very smart people smarter than me say the same thing, is that we need to fix the regulatory playing field for small guys and big guys. We should all play by the same rules. And if you are potentially going to do more damage to the economy or the environment or labor or whatever, you should have more restrictions, not less. So it's the big guys that should have the most restrictions because they have the most impact on the economy if they do something wrong. A little guy like me, I mean, if I open, you know, a widget factory here and I need 8 people, why on earth would they regulate me the same way they'd regulate GE? When GE had their problems, tens of thousands of people lost their job. If I have a problem, it's eight folks. So the regulatory framework greatly favors the big guys. And that is bad for entrepreneurship. And you've heard that we have a problem with entrepreneurship over the last decade or so. It's because it's hard to be an entrepreneur. It's very difficult because a good idea with a good product or a good service isn't always enough, because you have to go up against big guys who have changed the rules to favor themselves. And it probably needs to be changed, and it should be changed. And I think actually President Trump has done a small amount to help it, but there's a lot more to be done. Hold on 2 seconds. Shutting the office door because the little general Chihuahua Jack Russell decided that the Amazon guy needed to get off of my front porch. In any case, demographics really is the driver to economics. As the market grows, we know that as the population grows, we know the markets grow, right? It just makes sense, more consumers. And we know that younger populations and people going into their home building years, their household formation years, are the ones that spend all the money. So from the time you get your first piece of real estate, a first house, to the time that you're making babies and getting them through college, that 20 to 30 year window from, it used to be early 20s to early 50s, which is probably now late 20s to late 50s, that time period is our peak earning years, peak spending years. That's what drives economic growth. Well, Larry Summers, former Treasury Secretary, Bill Gross, the bond king, Jeremy Grantham, who's maybe the best forecaster out there, Neil Kashkari, president of the Minneapolis Federal Reserve, they've all talked about an age of secular stagnation, slow growth, and how to make money in slow growth and low interest rates. Nope, I don't have this in here, but and this is Neil Kashkari. He has a blog over on Medium. I really encourage you to go and follow him. I don't think he's put anything out recently, but he talks about all the exact same things that I talk about, which is that demographics are slowing the economy down. And over the next 30 years, that will be the case because we have an aging issue, right? So if we take a look at these charts, this is over at the United Nations, and you can pull up any country, right? Pick up any country you want. And this is one of the ways that I find ETFs to invest in internationally, is we want to invest in younger countries. So this is the United States. Look at this curve of people turning 65. Right? So by 2050, we're going to have about 80 to 90 million people, over a third of the population, or right around a third of the population, who are 65 or older. Right now, we're at half of that. And way back here, we're at, a tenth of that. So as this line rises, we have more and more retirement-related expenses, so Social Security and Medicare. And we were very bad at saving for the boomer retirement. We basically didn't. So in about 2035, there will be so many people on Social Security that they will only be able to afford to make about 75% of the payments. So between now and then, we have to figure out where we come up with the other 25% of the money. You can't tax enough to do it. It can't be done. So all these people who say tax the rich, yeah, there are inequalities and inefficiencies in the tax system that should be addressed, but it's not going to raise that much money compared to what we have to spend on Social Security and Medicare. And if you cut those programs, now you have a whole bunch of old people who are suffering. Is that what you want? So there is a very easy solution, and people will argue about it until they do it. And what they will eventually do is they'll just say, why don't we just print that 25% of the money, because we'll stick it into Social Security and it'll trickle out over 30 years. So therefore, it won't cause inflation. And that is something that, people, they pound, oh, we're getting inflation if the government prints more money. Well, no, because debt is deflationary, right? And putting more money in the system is inflationary. So why haven't we got inflation over the last 10 years, even though they stuck like $15 trillion into the economy? It's $4 trillion from the Fed and another 10 or 11 trillion through spending programs. Why is that? It's because they borrowed the money. So when you borrow money, that's deflationary. It offsets the inflationary impact. Well, the same thing could be done with Social Security, and we're going to need $30 trillion to fix it, and then another $6 trillion to bail out the pension plans that are all underwater, particularly municipal and state pension plans. So, so let's say we borrow $40 trillion in a while. Do we really need to borrow it? Why don't we just print it? It has the same effect, because if you stick it inside of a true lockbox, like Al Gore suggested, if you actually put it into some sort of investment vehicle and let the money trickle out over 30 years, all it's going to do is offset the deflationary impact of aging. Because as we know, and I've showed the Harry Dent charts before, we know that these folks, the green line, they don't spend as much as the red line. And the red line is leveling off. See how it levels off here? Just as this one's accelerating. So we've got about a 20 to 30 year period where the population going over 65 is accelerating, but the population under 65 is decelerating. Still going up, but not as fast as the point. See how the curve turns? This one curves the other way. So, and relatively slow growth on the baby front. And, you've heard some of the politicians say, well, we just have more babies. Well, resources are finite. Land is finite. Water is finite. We really don't need more people on the planet. We're going to get them. We don't really need them. So to offset these demographic issues, there's going to be major programs in the future. And the Austrian economists, who I like to pick on because they're just oblivious, this idea that we're going to wring out the inefficiencies in the system and let people suffer for a while and then it'll all work out. Man, how many of you were stressed out during 2008 and 2009? How would you like a decade of that? So, Avi Gilbert talks about a potential period where we have a horrible decade. We don't need to. All we have to do is, honestly, is print the money one time, bail out the retirement system, and it all work out. And I'm going to tell you something. I had a really interesting conversation with a guy a couple of years ago, major political strategist, knew Dick Cheney for 40 years, or I guess has known him for 40 years. Because I told him that one of the things that I would like to write about is I'd like to write a book from the standpoint of a fly on the wall of every room that Dick Cheney has ever been in. Because that guy, like him or not, is the long game in American politics. He has been involved in American politics forever, and he's influenced multiple presidents. And he said, back during the Reagan administration, when people were complaining about the rising debt, that's really when deficit spending took off, was under Reagan, and then everybody else just said, yeah, me too. Debt doesn't matter. So I don't think he says something like that if he doesn't believe it. Why would he say it? Because of what I just said. Eventually you get to the point where you're like, okay, we have to make sure the baby boomers are okay in retirement. How do we fix it? Why don't we just jam a whole bunch of money into the lockbox? Al Gore knew. What do you think? Where do you think that money was going to come from? They were going to print it, stick it in the lockbox. I hope they invest about a quarter of it in the total market index. And now all of a sudden you've got a world where the debt doesn't matter. All the programs are funded. The wealth generation machine has a new major customer. Take a look at Japan. Japan, the nation of Japan, right, the government, is the largest owner of ETFs in that country. Keeps them afloat. Now, Japan has a major resource crisis, and it's just going to get worse, and their population is the oldest on the planet. So we can look at Japan and figure out, okay, what have they done that's worked and not worked? Let's skip the stuff that didn't work, and let's double down on the stuff that did work. And what I'm saying about we're going to be able to get out of this problem at some point with enough gumption, it's going to go down that way. I have no doubt in my mind. So what do we do as investors between now and then? Well, what we do as investors between now and then is not give in to this pessimism that's in there, which is really pretty stupid. And I say stupid not from the intelligence standpoint, but the emotional standpoint. I have harped about emotions all the time. I'm trying to teach people to be cold-blooded killers when it comes to investing. Just like when I go to a poker table, I don't care if you're my best friend. I'm taking your money. I'm trying to anyway. And once in a while you get mine. About a third of the time you get mine. About 2/3 of the time I get yours. It's a pretty good game to play, right? If you could win a game 2/3 of the time, why would you ever stop? And that's kind of where I'm at poker. That's where I am at investing. So, the losses in both poker and investing, the trick is to keep your losses small, right? Don't lose the big hands. And last year I lost a big hand, and I'm pissed off about it still. But in investing and in poker, actually. But the poker one was, that was a anomaly. I was an 88% favorite, and I lost. With the investing, was screwing up on the end of the fourth quarter last year. That was something I didn't foresee, and maybe it could have been foreseen. Granted, I have a high level high bar I try to get over. 90 some odd percent of people didn't see what was coming last year, and I talked about what could happen, started to get out of the way, and then I stepped right back in front of the truck. It was like a train coming down the tracks, and I got off the tracks, and I'm watching. I'm like, why don't I jump out there anyway? I don't know, screwed it up. In any case, when it comes to the investing here, we have to take a look at all of these different concepts of demographics and budgets and fiscal and monetary policy. And the folks who you hear from over and over again about the central reserve, the central banks and the Federal Reserve keep screwing things up. It's not that they screw it up with their monetary policy. The monetary policy has actually been fairly good, excluding a little period under Greenspan where he had no idea what to do. And I worry about that with Powell. I think Powell is underqualified for the job, but he's got good people around him, and I think he's figuring it out. Where they screw up repeatedly, and Greenspan screwed up on this, Bernanke a little bit early in his tenure, and Powell for sure right now is screwing up on this, is they're not regulating the banks very well right now. And the market for collateralized debt obligations, you remember that? You remember CDO? If you haven't seen the movie The Big Short, load it up on Netflix. We have synthetic CDOs right now, which are making bets on real estate and other assets where the counterparties aren't strong enough to back the claims. And we're going to have a blow up in that. Anytime, as soon as the next recession comes and real estate starts to tumble because occupancy rates go down and rent rates go down, all these attached derivative securities are going to have a problem. And that's going to have a knock-on effect on liquidity. I don't know when that happens. It doesn't happen this year, but it could happen as soon as next year. But when you take a look at history and you try to analyze the financial crisis and make parallels to today, there's definitely parallels. Bush cut taxes on the wealthy. and corporations, Trump did the same thing. They both loosened up on the regulations on the banks. They both allowed higher leverage with the banks, and they're both allowing these CDO markets to really just take over wherever they want to take over. We have the huge buyback boom supporting the stock market now, and I've written that when the buyback bubble ends, stocks will return to more normal valuations. And maybe we shoot through to below normal valuation for a little while, and that's a great buying opportunity. But it's all triggered by the fact that we don't have the normal growth that the growth that we have come to think of as normal. Why has the economy only grown 2-something% a year for a decade, despite all this money being printed, borrowed? It's this reason, right? It's the aging of America. We're getting older and older and older and older. And granted, some of this is life expectancy, but the reality is that we just have a big glut of people there, right? The baby boom is a huge glut of people. So the millennials and the Z generation, as the boomers die, will become bigger. And that's when the line levels off again. But that's literally 20 to 30 years out. So will we get spending from the millennials and now that they're calling them Generation Z, the 21 and younger group, or 20 and younger group, I think it is, whatever, different groups define it differently. We're going to get growth. But because we have to funnel so much money into healthcare and the retirement system, and that money generally doesn't get spent at a very rapid rate, right? It's just, you got 60% of the population that just gets by. And we can't just let them, can't put them in some dystopian movie scene. There's obligations, and they're unfunded, and we got to figure out a way to fix it. And eventually we will. But between now and then, it's going to be choppy, maybe for another decade. So what you've seen in the stock market the last 18 months is probably what we're going to see for years and years and years. Now, the trend will still be up until we get that one big drop, right? So if we take a look at SPY, which is 90% of the stock market capitalization, we go back, get the 2000 crunch, financial crisis, straight down, and then we recovered. And right around 2015, it looked like we were going to have a recession. But what happened in 2015? Oil prices got real cheap. So we get another rally. We get this fall here. Look how steep that is. What does that look like? But it stopped. Why did it stop? It stopped because we have the effect of the tax cuts right now. When will those tax cuts wear off? When does the money that the corporations have not be enough to support things? And the answer is the next few years. Could be as soon as next year, could be a few years after that. It's hard to know. We could get one more rally up into here. I said a year and a half ago, almost 2 years ago, we were going to get to 300 on the S&P 500. I think I said it right. July of 2017. Right. So July of 2017, right about here, I said the stock market would get to 300. S&P 500 to get to 3,000. SPY would get to 300. Said that right about here. Market gets up to here, goes all the way back to the same spot that I had originally set it. And I said, you better buy because we're still going to get to 3,000. I don't know who did and who didn't. But here we are again at 293. And I'd be surprised if we don't get the, 310, 310-ish, give or take. That was my original projection for this year, 310-ish. Could be first quarter next year. We get some chop. And next year, I think it's going to be tough because of the election cycle. Everybody's going to be uncertain. Nobody likes uncertainty. The market doesn't like uncertainty. People are going to be trying to lock in their tax break, right, in case Trump loses. I think next year is going to be choppy. A lot of selling, a lot of buying, selling, and ultimately, I think we get this again. And could it go further? A little further? Could it go all the way down to here? I think that makes a lot of sense. Doesn't it make a lot of sense to you, that level right here? I think that level right there looks pretty potential. And could it get all the way down to this level? We'd have to have a crisis to get all the way down here. I don't think we're going to get down to 160 on the SPY, but that 220, 230 area, yeah, I think that could happen. So, and I've talked about that. But it's all derivative of the aging demographics. All of it. Global debt is a problem, but, we can make more. It's like Doritos. There's always a way to work your way around debt. You just got to wipe somebody out. You don't want to be the one getting wiped out. Who will get wiped out? I suspect that eventually Japan's going to have a big problem. And when Japan finally has their big problem, that will accelerate everybody else's problems. So given that Japan has the oldest population on the planet, and global trade is changing in a way that supply chains are moving closer to the consumers, right? So they're going to lose some export business. And given the fact that they have major resource problems, I think the next big shoe to drop is probably in Japan. Although I think a pretty strong argument can be made for Europe as well, and somewhat of an argument made for China. But I think the next big problem comes out of Japan or Europe. I'm pretty certain of it. China's a lot stronger than Americans want to give them credit for. And let's just face facts. To say that we're not prejudiced as a society is kind of silly. Clearly we are. China has been whooping butt for a long time, and there's good reasons for it. Productivity still hasn't gone higher. Unemployment rate came out today. It's the lowest since 1969, but wages are starting to finally go up. What if wages actually do go up 5%? Right? Think about that. What if wages go up 5%? Now, there's a lot of people out there like, well, that's my normal raise every year. Well, not for 60 to 80% of the population. 60 to 80% of the population doesn't get raises. But what if more companies follow the suits of Walmart, biggest employer, and Amazon, a big employer? What if McDonald's, instead of robotizing, because I won't eat at McDonald's with robots feeding me. I won't even go through the line that has me do the scanning myself. If I'm not saving money, why am I going to waste my time? I'll let if I'm going to pay for it, I might as well pay a person and let them get some money. But what if wages do go up across the board, 5% or 10%? Where does that come from? Comes right off the bottom line of these corporations until they can pass it through to us. But what if they start passing it through to us? Then maybe we don't buy as much stuff. So, the idea that corporate earnings are going to stay as high as they are is a fallacy. We know the CAPE, right? You guys know all about the CAPE, right? So we can take a look at the I forget what they call it here. This is something that people don't understand. They don't understand the CAPE ratio. This is basically normalizing for earnings over 10 years, and there's actually a better measure of this now. But for showing relativism, relatively where we are, we're right around, after the correction, things came back, and now they're going up again. We are in that area where we have the second highest priced equities in history, or second or third. And that's important to understand, because usually what triggers a market sell-off is a recession, and then the recession triggers earnings to go down, and then the stock market follows. Or maybe the stock market goes down first because it knows. But in any case, when you have a CAPE ratio that's real high, what it really truly means is that the risk of a reversion to mean is greater. Doesn't mean it has to happen right away, right? can go for a really long time. And it's possible the stock market goes up to 4,000 on the S&P, and the CAPE ratio just keeps getting higher. Could absolutely happen that way. So what we have to do when we pick out our investments is put all the factors that we can in our favor. Younger populations, where is the growth, right? Growth is important. I know people love their dividends, but dividends don't hold up if there's no growth. So look for the growth first, or if you're going to look for the dividend first, then you got to go at least find out, is there growth to support that dividend? Ask GE about that. Right? The GE situation is coming to a lot of old economy stocks. You can believe it or not believe it, but it's all driven by this underlying demographic shift. And one of the places that I would be extremely careful about, as I finish up here, is REITs. And Dividend Sleuth and I are going to be writing about REITs over the next couple of months. And something I've been talking about just a handful of people, including some big real estate investors I know, is what happens if occupancy rates drop 10%, which is not uncommon, and rental rates drop 10%, which is not uncommon. Just under those scenarios, just 10% drop in rental rates, 10% drop in occupancy rates. And what could drive that? Machine learning, right? The ability to have more and more people work from home and still be able to monitor what they're doing, right? So it used to be they didn't want you to work from home because they didn't think it'd work. But now they can monitor that. So more and more people working from home, less days a week at the office. What if companies decide, well, we don't need $30,000 of office space in pick a city, Chicago. Maybe we only need 20,000. And seeing as other people are making the same decision, we know that we have a lot of 20,000 office spaces out there. You know, I guess we could keep the 30,000, but they still need to lower our rent for us to stay. That's what's coming. And it's going to happen in the industrial space, probably least of all, because supply chains are in fact moving back to America, or at least sprouting up. And that's because of the machine learning. It has nothing to do with tariffs. And if tariffs do have something, I don't care if the tariffs have something to do with it. It's just, we know that it's happening. Tariffs probably don't have anything to do with it. It's probably the machine learning. So industrial space is probably safest. But when you take a look at apartment rentals, they've overbuilt on apartments in most cities and on condos, but we don't have enough single family homes. So, what are you better off getting into? And single family homes are pretty darn expensive right now, but I still find bargains on condos, and you can find apartment specials during parts of the year, depending on where you are. Is there a university nearby? Things like that. But those REITs, if they lose 10% of their revenue, take a look at what happens to their dividends. They have zero dividend coverage at that point. If they have zero dividend coverage and they don't think they can recover it in 2, 3, 4, 5 years, what do? Do they borrow their way through it and leverage up even more? What if interest rates go up 5 years out? So the REIT space, really, I think about 2/3 to 3/4 of it is at very high risk. And I had somebody say to me on a chat board yesterday or the day before, why would you be concerned about REITs? They just go up. I remember back in 2006 and 2007, some little kid, some 35-year-old at the time, that's about how old I was too, said to me, real estate always goes up. Why don't I just buy real estate instead of stocks? I don't think you should buy either one right now. They're both going to get hammered. Nah, I'm going to buy real estate. So he bought some $700,000 four-family building, and during the financial crisis, it went down to about $440,000. And he was like, "Oh my God, I'm underwater." And I'm like, "Well, do the rents pay the mortgage?" He goes, "Barely." Well, you're just gonna have to tough it out. Well, then he had repairs on that building, and they were major repairs because he was too dumb to know the roof had to be replaced. Bad things happen. Bad things do happen. But it doesn't mean that we shouldn't be bullish long term. We just have to understand how these fluctuations could play out. So when I talk us through these things, it's not necessarily to make a very specific, precise timely projection. It's just to say, look, these are how the scenarios probably play out. We need to be ready for them when they happen. So does this stock market run up to 4,000 on the S&P 500? It could. I don't think it does. I think that we probably get a pretty major correction before that happens, but it's not cut in stone, right? Back in 2012, 13, 14, and 15, I was telling people that the United States would get some huge GDP years because we'd have a window of time, several years at least, we'd have a window of time where the energy picture was really good for the United States. Exporting natural gas, maybe exporting oil, we didn't know back then. But in general, we'd have control of our energy picture. To the point now where even though Saudi Arabia can get oil prices up to around $70, $80 a barrel, they really can't push it any further. Because at that point, you get competition. So there's this Goldilocks price of oil, and it's a big deal. So for the next several years, we probably should have above-trend GDP growth. And we should be smart in how we interpret that. Was it really the tax cuts? Was it really allowing leverage? Maybe, yeah. Those are probably just bad things that are going to come out in the wash someday. The reality is that we have a good energy situation, it'll probably get better, because as of last week, I guess, a major Indiana utility was like, it's cheaper for us to tear down an existing coal-fired power plant to do solar and wind and batteries. That's today. It's coming fast, folks. So we need to understand the changes that are coming, what the demographics drive, how we're probably going to fix some problems. What does that mean for us? It means that probably every now and then we want to accumulate some cash, like I've been accumulating. I told you early April, fade the rally, and I'm at like 40, 50% cash right now. Although I have a high beta portfolio, so I'm fluctuating as much as everybody else, dollar and cents wise, but I do have this dry powder sitting there if I do get a chance to buy something I like, or if we get a correlated correction. Today I bought a little Tesla. So if anybody has a question, fire away. I know I rambled for 45 minutes. Yeah, so foreign affairs covered basic. Oh, I didn't even know that. So foreign affairs covered what I just talked about. It's that the United States really doesn't have a spending problem. We have a revenue problem. So everybody who says that we have a spending problem, not a revenue problem, like the now retired House Speaker Ryan, it's not true. Spending's been basically in the same range for 40 years. So when Reagan cut taxes on the wealthy, when Bush cut taxes on the wealthy, and when Trump cut taxes on the wealthy, we got a mini boom, 2, 3, 4 years. And at the end of that period, at the end of Reagan, at the end of Bush, we got big, big corrections. Do you think it's going to play out any differently under Trump? No. When you create a sugar high, you got to come down from it. And that's what he did. We would have been better off letting things progress organically, but we didn't do it. Occidental, you should be buying Occidental all day long. I've written about Occidental. Just read what I've written about it. They are in a good place. Either they get Anadarko and it's $1.5 billion to the good at the end of the day, or they don't get Anadarko and they end up getting a couple other companies for cheaper, and those are going to be accretive at the end of the day. All these deals in the oil patch are going to be accretive. The fact that Norway just dumped a whole bunch of stock, that's temporary. It's done. You know, there's not much left for them to dump. So even with Norway dumping $7.5 billion worth of oil and gas stocks, all we did is get this little itty bitty correction. All right. Yeah, we'll get a lot of publishing done in the next week. For the group, what percentage of portfolio is a position in a stock? A starting position is a half. I mean, this is all written down. It's all written down. We have it all laid out. So if you go to margin of safety, and it's over at fundamental trends too, getting started, you know, building and maintaining a portfolio. I bet there's a chart. It's all right there. I mean, this probably should be like 5 pieces just to make it. Yeah, there you go. 0.5%, 1%, 2%, 4%. You really don't, you know, and you can fudge that. It doesn't have to be perfect like that. That's how I do it. I usually skip the 0.5%er and I go straight to a 1%er. Then I build it to 2, and then I build it to 4 if I really like it. You know, have I had positions that grow bigger than 4%, or that I bought in for more than 4%? Sure. I backed up the truck on Exact Sciences when it crashed from 30 to 6. But, you know, it's rare that you're going to do that. You know, you want to have 20 to 30 stocks if you're a stock investor. If you are doing a blended portfolio of ETFs and stocks, you know, maybe you have 3 to 7 ETFs that don't get traded very often, and you have maybe a dozen stocks because that's what you have the time to keep track of. A dozen stocks with a core portfolio of ETFs is generally safer than the stock market with more upside. Pretty basic, right? If you have 2, 3, 4% more upside, and you're only taking 80% of the risk of the stock market, that's a great equation, right? So, you know, this isn't rocket science. You know, if you end up with a dozen stocks all at 2% and a couple more at 4%, and then you have the rest of its ETFs, you're in good shape. Now, if you have the time to monitor 20 to 30 stocks like I do and do it for a living for multiple portfolios, yeah, I've got portfolios with 20 to 30 stocks, and they have, you know, every now and then we throw QQQ in there, or a regional or a country or sector ETF. And then I count that as, you know, in my head, if it's 12%, I think, okay, that's 3 stocks. So there you go. It looks like Norway is almost done. It looks like they dumped them all over the course of a month. You know, they might have a little bit more to sell. You know, we don't really know. All right. Have a good weekend. The weather is good in Wisconsin, so I'm going to go outside for part of the day tomorrow. Dig up the garden. Have a great weekend, everybody.